And on today's show, how to use a cash value life insurance policy to enhance retirement income. Part 5 of this week's series on the impact of QLAC and emerging insurance products in retirement with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome to the show, Mike.
It's great to be back here.
I got to tell you, this week has been chock full of unbelievable information. And again, if you're just coming to our show today, I highly recommend that you watch the whole series in its totality. I think you're going to really benefit from it in your practice as well. When I think about saving this to last, because we've talked about so many things, qualified money, non-qualified money. Now we're talking about QLAC money, right? Let's talk about this new idea. Well, it's not really a new idea. Let's just say it's a enhanced idea. Is that a good way of saying it?
Yeah,
okay.
yeah. And I think it's important. Why we want to bring this out again is, you know, we really have the opportunity to talk about diversified portfolios. But when you say that, you're always thinking about, I'm going to put money in different types of value funds, growth funds, bonds, and junk bonds, and all kinds of different things. We usually think diversification that way. We need to also change the game in talking about diversification of product and also think about the end game. And the end game is income. And it's not how much that we draw out or how much that we make during accumulation. It's how much that we're able to keep and how much that we're able to put into our back pocket. And that's where that just talks about.
So you suggest, I mean, I think a lot of people think, we do think in that way, product diversification, asset diversification. I don't think we hardly ever talk about tax diversification.
No, not at all. Not at all. And it's an important, and then also fee diversification. You know, this is an issue with a lot of fees because we're talking about qualified accounts here. And qualified accounts can be really, really expensive when you talk about the fees. In fact, if you remember from our Monday show about plan documents having to be changed to make sure that it gets QLAC, that's an expense. And that expense is going to be passed into either just hard set fees for pension people and qualified accounts, or they're going to come with a higher 1 to 1.25% in terms of the asset fee, so they can pass that fee in a variety of different ways.
And remember, Mike and I did a show specific to qualified plan fees and expense loads, and if you say, Steve, I'd love that, just write me and I'll be happy to send you the video. Mike, walk me through this now, because we're talking about, I still got to pay a little tax on this to get this out of here, right? So walk me through why I'm doing this and why the life insurance from a tax point of view is an enhancement.
Yeah, life insurance, because of the income coming out, is a great enhancement. It's also, we talked about fee drag. We talked about tax drag coming out of that. So this is an opportunity to really kind of do kind of a Roth type alternative. So in this year, we have our current strategy of $1.5 million in terms of the qualified plan value. We basically put in premiums of $960,000 into a life policy. And then what ends up happening here is the potential gain due from the planning is over $750,000 in the client's advantage by using a life insurance in terms of more income and then having saved more from fees, expenses, and taxes on the back end through life expectancy. Now again, we talked about kind of building blocks. So you could do this type of strategy for between 65 and 75, and you could put part of your qualified money into a QLAC to turn on at age 75. So you can begin, the QLAC adds another dimension into the planning process, but I think what the QLAC conversation allows you to do with your client is to open that up and begin to think about different blocks of building blocks to use with your clients.
Now, when I'm thinking about doing this, because life insurance needs a little time to cook, right, to get the numbers working, what kind of timeline am I looking at that I'm paying my taxes coming out of a qualified plan, I'm getting rid of my fee drag, right, some of the things that are disclosed in the 408B2 on a qualified plan. How long do I kind of have to sit and make this work for me?
In this particular example was 24 years. However, I would say that if you're anywhere between 15 to 20 years, you're really comfortable with that, which again, the QLAC isn't for age 70 and a half. It's to go out and talk with your younger clients about getting in position. And the longer that you can defer that QLAC, the more income that you're going to have. And if you do it earlier, then you can have income earlier at age 70 or 75 and manipulate this between 60 and 70 and maybe get your client to retire a little bit earlier when most Americans are thinking, I'm going to have to work longer.
Do you think millennials, just a little side note, do you think millennials are ready to talk like this in their 40s and 50s, early 50s?
I think the pendulum is swinging. You know, again, a lot of clients are more than willing to lock up their money and you have to have a long-term strategy with life insurance, but the vast majority of people are really concerned about the number one fear, more than flying in an airplane and public speaking, is living too long right now. And this is a great reason to go out and talk to your clients about how do I protect longevity, and then how do I make sure that the people that are depending on me are going to be able to really depend on me if I'm not here.
When we come back from the break, we're going to talk more about wealth transfer and income that's tax advantaged right after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance, designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the Practice Enhancement Company. Well, welcome back to the second segment. Of course, we're with Mike McLaughlin, nationally recognized annuity expert, but we're talking life insurance this time. Mike, you're dipping into my area.
Yeah.
Let's talk about this, because I love this idea, the basic impact that this has. And this is really a good piece, not only for rookies and newbies in our business, but for seasoned pros and vets. Walk me through this.
Well, let's think about, again, what we've talked about from the target market on QLAC. Mass affluent, and for people who are concerned about outliving their income. One of the biggest problems with longevity planning is sequencing of returns. Here you have Tom, who has a retirement account. If they mirrored the S&P 500 returns from 73 to 93, he took $1 million and took annual retirement income and inflated it up by 1%. His retirement balance at age 85 would be $440,000. However, if you took those same scenario between 1990 and 210, he'd still have $2.1 million to pass along to his beneficiaries. So, you know, Tom Hegna has a great story in terms of, it's not when you get here or get to zero. This is when Tom really begins worrying, because his life expectancy at retirement is probably 30 years or so. He's going to run out of money here fairly shortly. And it's that grind and the uncertainty of, when does this 440 last? Because if you have a year like 2008, you know, all of a sudden that 440 turns into 280 very quickly.
Probably the most creative commercials that are out there right now are those Prudential commercials. There's 3 of them out. Whether you're looking at who do you know who lives longer, pulling the ribbon, and their new one, how much money do you have in your pocket? It really helps demonstrate to the consumer mind, this is what we're up against, and this is not going to make it. So our tactics, our strategies are there to elongate or make it more elastic in our retirement thinking. Now walk me through that, just to make sure, I want to make sure understand. I get the transfer to my heirs. That's really great. But is the income still working?
The income is still working here, because this really doesn't have any type of life insurance in it. But again, that $2.1 million is taxed. And if I'm passing it to a working child, maybe they're at the highest tax rate, all of a sudden that 2.1 can very easily turn into $1 million very easily. So one of the things that we're having a lot of success with is talking about, how do we stabilize income? Not how do we stabilize the asset value necessarily, but how do we stabilize the income during retirement years? And in this scenario, Tom actually diverted part of his retirement savings into a cash value life insurance, and still did his 401k. So started out at $1 million at age 65, but also had some cash value through making about a $7,000 a year premium payment into life insurance. All right, has a $500,000 death benefit and about $233,000 of cash value. We're taking a look at actual returns over the last 20 years here. We had a negative year here of about 15%. So instead of taking out $70,000 that he needs, we took out $50,000. Why only 50? Because not taxable here. $50,000 is actually what Tom keeps had he taken out that $70,000. So we take out $50,000 every year following his account balance going down. That leaves his account balance an opportunity to recover. So in this particular scenario, his recovery year was 37%. So then we're not taking any withdrawals, we're taking the full amount indexed for inflation all the way out here. So every one of these black boxes here represents a time when the market was down and we leveraged the cash value with inflation to maximize his rate of return.
Okay, so Mike, let me make sure I understand what you're saying here. So when I have a negative year, I'm taking probably withdrawals to basis, maybe, or policy loans, depends, but maybe withdrawals to basis. So I'm not going to take any money out of mine because it's negative year and it would be hurting my fund overall accumulation. So I'm leaving that alone and I'm going into another asset that will not cost me anything in taxes, whether it's loans or withdrawals to basis. So you blocked out the negative years, and those are the years that you're taking withdrawals or policy loans out. When you look at this, have you shown this to our advisors at some of the meetings that you've been at recently?
It's eye-opening because most advisors didn't think of life insurance as a retirement planning tool, and most importantly, they didn't think about it as an income diversification or an income stabilization tool. End result here is Tom, best case scenario was about $2.1 million. He ends up, because we're not creating that snowball effect when the market's down, he ends up with nearly $3.6 million in his investment account. He has $213,000 of tax-free death benefit and still $86,000 left in his account value at his life expectancy.
If he would not have done this and stayed true to his 401k or whatever qualified plan he was in, what would be the remark? When would he run out?
Well, he would have only had about $440,000, so he would have been running out of money very shortly because he's taken out 85, and if he has another 2008 of minus 27 and followed by minus 14, then that thing looks really bad. And again, as Tom Hegna says, it's not the year that you run out of money, it's the years that you're coming up to it that creates the stress and the heartache and the family problems when you know that you're going to run out of money or have the potential to run out of money. And that's how diverting life insurance early on, or money to life insurance, and stabilizing your income can really be beneficial.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you next week.